Well, this is Current Yield, ladies and gentlemen. I'm Jim Grant, and this is first week back to school, I guess. We're recording on the eve of Labor Day, but it just has a first day back to school feel about it. It's kind of a certain amount of dread. Or maybe that's because the 10-year yield is now approaching 1.35-ish or so, which was the bottom in 2016. So as a friend says, we're either in for the double bottom of all times or perhaps the combustion of the entire situation. Well, no more than 10 years. But with us today, as is customary, Eric Whitehead is the dials, and the great Evan Lorenz, deputy editor of Grants, is here, as is wont. And to my right is Marty Fridson. And Marty is the CIO, the Chief Investment Officer of Lehmann, Livian, Fridson Advisors LLC. Now that Lehmann takes two N's, so as to clear up any waggish confusion. Now, I want to say one thing about the New York Times. Now, the New York Times is coming in for some heat. Have you been following this, Evan?
Is this the bedbug thing?
No, it's the whole, there's a certain amount of astringency between the Times and some of the power figures in Washington, D.C. But I want to absolve the Times of factual inaccuracy in one respect. Here's what the Times said about our guest today, Marty Fridson, CFA. He said, quote, "one of Wall Street's most thoughtful and perceptive analysts," period, close quote. I don't know, that's nice as far as it goes, and it's certainly accurate, but for example, ladies and gentlemen, I'm going to give you a sample of critical praise a little closer to home. I've written a book, as is my wont, biography of Walter Bagehot, who was the editor of The Economist in the High Victorian Age. And here are some excerpts and reviews, a little like Marty's. They're nice. New Yorker calls it lively. New York Times, excellent. Financial Times, engaging. Wall Street Journal, terrific. Financial News, terrifically enjoyable. Foreign Affairs, entertaining. Ryan, gloriously eccentric. But still, there seems to be some holding back of critical acclaim until you become to this, the greatest book in the English language. Now, that is a blurb. Marty, would you care to read the attribution to that particular blurb?
Yeah, that's from Grant's Interest Rate Observer.
Oh, how does that get in there? Anyway, Marty, it's a pleasure to have you. And this is I'm sure that you are familiar with Sidney Homer's and Dick Silla's 4,000-year survey of history, right? And nothing like this. They say that nothing's new under the sun in finance. We live in newish times, no?
Yeah.
What is newish in your part of the world, which is, of course, principally high yield, but you are a most eclectic participant and observer? What is newish or new in the markets you watch most closely?
Well, one thing that's almost unprecedented is that the spreads on the higher end, called double B and single B, is below its historical average currently by about 75 basis points. The triple C and lower portion of the market is about 100 basis points wider than its historical average. So in effect, they're giving opposite views about the outlook for the economy and the credit outlook. The higher end essentially saying things are fine by the lower end because that'll do better if things hold steady or the market gains from here, hard as that might be to imagine. Whereas the triple C and lower paper is saying, looks like that recession risk.
These are bonds we're talking about now.
Yeah, okay. Yeah, these are bonds. Yeah.
How about the same spread in the so-called leveraged loan market? Leveraged loans, of course, being tradable senior bank debt, mostly secured, but not always secured. But how is this triple C segment of the leveraged loan market priced with respect or in comparison to the better rated segments of that market?
That's a very large portion of the loan market. In fact, there's been a tremendous expansion of the universe of rated issues by Moody's to the point where you really can't compare the statistics to the past because there are just so many loan issuers. So, it's complicated life a little bit, but I think you are seeing great optimism there. And the high, and I should emphasize that for the high yield bond market itself as a whole, the spread is not only below historical average, which I put less emphasis on, as opposed to how does it compare to where the spread ought to be given the risk factors that drive that spread historically. And those in brief are the credit availability, which is drawn from the Fed's quarterly survey of of senior loan officers, a couple of economic indicators, industrial production and capacity utilization that happen to be highly correlated, more so than unemployment or GDP, and the level of 5-year treasuries, which is inversely correlated with the spread. So summing it all up, the spread is much wider, to the tune of like 2.5 percentage points narrower than it ought to be, given where those factors are currently, which is quite an extreme.
Now, we're talking about loans or bonds?
Yeah, these are on bonds.
Bonds.
Yeah.
Could we go back to loans for a second? But given the perhaps incomparability of data owing to the vast expansion of this market, is it nonetheless the case that the loan market is imputing the same questionable economic future with respect to as reflected in the pricing of the various grades of loans? Are the worst rated loans trading at a big premium to the better rated loans, or as reflecting the bond market, or is it entirely different?
No, I wouldn't say it's entirely different. The loan market is pretty much in line with the bond market if you compare how those look on a rating for rating basis over time. So yeah, so one important thing I'd have to say about that overall judgment of the high yield bond market, though, is that a lot depends on how you view the whole issue of quantitative easing. During the period in which that has existed, where the Fed uncharacteristically has bought long-dated bonds as opposed to operating solely in the short end of the market, spreads have been about 150 basis points tighter than they were under similar conditions, prior to that period. So it makes an important difference whether you view the quantitative easing period as being over. I made the determination.
It's never going to be over.
Well, I made the determination around year end that with the Fed looking to raise rates, they were talking about letting the portfolio run off, that at least we weren't doing more quantitative easing, but they quickly reversed tracks to the point where now I'm confused, and I just put out both versions of this analysis. It's still somewhat overvalued, even if you take it that we're still in quantitative easing, but not as to the same extreme.
What is overvalued exactly?
Well, this would be the risk premium on the high yield index as a whole. So in effect, the entire high yield market is much too expensive.
Much too expensive. Yeah. You're a practitioner as well as an analyst. Are you finding anything to buy?
Well, we run a income investing management business, so we're not restricted to high yield bonds. In fact, they're a relatively small portion, particularly now because of the valuation. The asset class among those that we look at, which also include preferreds, real estate investment trusts, dividend growth stocks, closed-end funds in a variety of asset classes, but all income generating. The one that stands out now really is the master limited partnership, which gone through a rough period. It's not totally unexplained or baffling that the spreads are and yields are high on those, but we nevertheless do see some value in that sector in the aftermath of a lot of volatility in energy prices and also some unfavorable regulatory changes affecting that sector.
Yeah. So I didn't hear negative yielding government securities in that list of opportunities. Is that an omission? Is intentional?
Yeah, it is intentional. Our clients tell us they want to preserve principal, but foremost they want to generate income, not pay it in. So
there's no accounting for taste, is there, Marty?
No. I mean, God bless those who want to own negative yielding bonds. They're fulfilling a role right now in some sense in financial markets, but that's not our target market.
Marty, as you kind of look at the high yield market overall, loans plus bonds, like how junky is the market today, and how does it compare to other, I guess, cyclical turns like on the eve of the 2008 recession?
Well, it's actually improved from then. If you look at it, and again, I haven't.
When you say improved, do you mean bonds or bonds plus loans?
Yeah, well, I would have to focus on bonds. I have to say I haven't done a breakdown of the loan index in the same way. But on the bond side, the percentage in the bottom tier, triple C and below, but not already in default, is actually down from 24% at the end of 2007 on the verge of the Great Recession to 14% currently. That's counted by number of issues in the index and how they're rated. And the significance of that is that, say what you will about the rating agencies, they do almost invariably get bonds down to somewhere triple C or below, and frequently to at least double C before they actually go into default. So if you're concerned about defaults, that's really the segment of the market market to look at. Now, you may have downgrades from, let's say, the single B sector to triple C and eventually defaulting, but that triple C percentage is a pretty good indicator of the risk in the market.
Well, GE, I guess, is the big outlier in that observation about the tendency of the agencies to get to triple C before D. Except for the administrations of the U.S. government, would not GE have gone from AAA to D?
Well, they certainly got a helping hand. They were not alone. I was among those, I have to say, that was concerned about the moral hazard problem prior to the global financial crisis. Henry Paulson said at the time, yes, I acknowledge that as an issue, but right now we have a crisis on our hands. And I have to say that had they stuck strictly to that moral hazard problem or issue, they would have had a lot of other investment banks go down, including some of the really blue chip names in that business. And judging by the reaction of the market, the economy, banking system to the failure of Lehman, our non-namesake institution itself, I think that the damage was certainly worse. I don't believe that the Fed and the Treasury would have stood by and let Lehman fail had they recognized what the consequences would have been.
But you know what? It's always a silver lining, Marty. For example, if the world had actually all failed, there would have been a lot of openings for new hires, right, in different industries. Perhaps if you were in the business of hiring people and had trouble doing so. I mean, this is it's one of the features of our financial lives. The labor market is tight. So how do you find qualified candidates? Usually it takes a long time. Too many applicants, too many false positives. This is where ZipRecruiter makes it easy. ZipRecruiter.com/grant will deliver you to the site that will tell you about how you can hire better. So ZipRecruiter sends your job to over 100 of the web's leading job boards, but they don't stop there. With their powerful matching technology, ZipRecruiter scans thousands of resumes to find people with the right experience and invites them to apply to your job. As applications come in, ZipRecruiter analyzes each one and spotlights the top candidates, so you never miss a great match. ZipRecruiter is so effective that 4 out of 5 employers who post on ZipRecruiter get a quality candidate through the site within the first day. And right now, our listeners can try ZipRecruiter for free at this exclusive web address. And here it is, ZipRecruiter.com/grant. That's ZipRecruiter.com/grant. ZipRecruiter, the smartest way to hire.
Marty, the reason I brought up the question of how junky is the junk market today is right now everyone is kind of worried about a recession. I think yield curve is actually trending, and I've heard even my parents talk about it, which is not a normal dining room topic. But people are worried that we're going to end the longest business expansion in U.S. history at some point in the next year. And what does that mean for investing in asset classes that tend to default a lot? And you and I had actually had a conversation earlier this year about, given what the shape of kind of the loan and the bond market is, and given just a prospectively mild recession, what might defaults look like? Based off of what you see today, how might just a run-of-the-mill garden variety recession impact default rates in the market today?
Yeah, well, the loan market, because of the concentration in Moody's category of CAA, would feel a pretty harsh brunt of that. Now, there's one peculiar kind of catch to this, which is that in addition to this growth of the CAA sector within leveraged loans, there's also been a deterioration of covenant quality in both bonds and loans. And in the last cycle, that had already begun. And my response to that was, well, why did we have covenants in the first place if people are indifferent to the deterioration? And they're not all indifferent. There are actually companies whose entire business is interpreting the very opaque language in those loan covenants on behalf of the investor. So the point about it, though, is that there were those who said it's actually a good thing that those covenants are being loosened up, because a lot of companies that are ultimately viable would otherwise be thrown into bankruptcy as they violate the technical, they have so-called technical defaults, violating covenants particularly in their loans, and the creditors will panic and force them into bankruptcy. Whereas if you don't have that trigger of the protective covenants, those companies will get through it and everyone really will be better off.
Marty, give us an example of a technical default.
The loans historically have had what they call maintenance covenants, so that you have a test for fixed charge coverage, for example, or debt to EBITDA or some other measure of that kind. And if on a given financial statement date, a quarterly reporting date, you're below that threshold, above the level of allowed debt, you are technically in default. Now, that will not automatically result in the company being thrown into bankruptcy. Usually, the lenders will say, we'd like to monitor more closely. We want some measures to
or get a higher rate of interest.
Or make some change like that. But if they're worried that their recoveries will be less if they wait longer, and that there is and there isn't a likelihood of the company turning around, then they'll accelerate and force the company into bankruptcy.
Right. I'm thinking a lot about this negative rate stuff. You kind of wonder if you're of a certain age, are you missing something? So it seems so logical that interest rates ought to be positive. After all, as Irving Fisher himself pointed out, humans being impatient, they want things now. They prefer income now rather than later. And the price that the patient saver exacts for foregoing immediate gratification might be seen as a rate of interest. That's So the question before the House is, well, perhaps we've become less impatient as a species. But how would you square that with this? So 2G is not good enough, 3G is not good enough, 4G is not good. We need 5G. Or Amazon Prime. How has it made such inroads on the U.S. Postal Service if we are not impatient? Where do these negative rates come from?
Yeah, I think that the source is more likely in government policy and central bank intervention than in a change of from what and certainly what you're describing about impatience, I'm sure has some sort of evolutionary basis for it. So it's unlikely that in the last 20 years.
You ever heard the expression boarding house reach?
Yes.
Right. So it's when somebody was very quick to grab a plate off a family-style dinner. And I think that comes from the age preceding about 15 minutes ago in the human sweep of time that people were always hungry. Yeah. But all right. So negative rates.
To the government's credit, Marty,
No!
this is a point you made before. That in 2009, the high yield default rate was the highest it's ever been in history. And in 2010, just 1 year later, it fell below its long-term average. And you've said that's physiologically impossible.
He said, quote, it's almost physically impossible.
Oh, almost. Well, I would almost is probably too strong in that case.
But that was one heck of a hat trick the Fed pulled off by dropping rates to zero and by doing QE. But just as you kind of look at the landscape today in terms of how leveraged companies are, how junky the market is, if we do kind of hit like a sudden bump in the economy and the Fed does roll out QE again, can they kind of pull off the same trick, or is that kind of a one-time only party favor?
Well, I think that's really a $1 million question is kind of saying billion or $1 trillion question nowadays. You have to use that kind of term, and I think it's a fair question whether they used to talk about pushing on a string with respect to interest rates, and maybe QE has the same effect. In other words, you reach a point where reinstituting QE, pushing further, buying even more long-term bonds just doesn't have the same effect, and you cannot head off a recession.
See, that's where BlackRock has some suggestions for us. Yeah, BlackRock has, its senior executives, some of whom are alumni of the central banking world, have recently come out and said the European Central Bank, for example, ought to consider buying equities if bonds run short supply. And indeed, one of these worthies said that the European Central Bank ought to consider just kind of giving people money. So I was thinking, and Phil, the author of ADG, was thinking, why not? Shouldn't the ECB issue, this is going to sound crazy, but hear it out, gift certificates for BlackRock mutual funds to citizens of the EU?
Well, everyone's a winner in that one.
Yeah. All right. So interest rates are Martin Fridson, among other things. The Times doesn't know this, otherwise it would not have lauded him as it did in that uncharacteristic quote, accurate to be sure. Marty is a great one for, I think, the integrity of the marketplace. Martin is not just about securities or writing for S&P LCD, which he does with great erudition, but also I think you care about the situation, to use that quotation. All right. So interest rates, I think we can agree, are perhaps among the most sensitive and significant prices in a market economy, certainly among the most consequential, I would say, perhaps the most consequential. And we all might similarly agree that price control has been demonstrated as inefficacious over the millennia it has been practiced. But what is the muscling of interest rates except a species of price control, in that a most critical price? And if this were as bad as it seems, what does it say about the misallocation of resources, about the construction of redundant this's and thatses, of white elephants, of what's going on? What to take the consequences of artificial rates and to think about them. How do you think about this?
Well, malinvestment is certainly a great concern. I think that it was a factor too little emphasized in the era that people remember as the dot-com boom. To my way of thinking, it was an easy money period that just happened to coincide with an emergence of a technology called dot-coms. It wasn't as if in normal times you would have had the kind of make-believe companies getting access to the market. You also had the so-called business plan telecom companies, business plan because they had a business plan but no business at the time, and they were able to get access to the public debt market as companies that really belonged in venture capital until they got to a stage where they really had a viable operation. So historically, the other story, almost unknown, is that all the major motion picture exhibitors except AMC, which was the root of the problem, went bust during that period because motion picture exhibitors were able to continue financing even though the long-standing rule of thumb of one screen per 10,000 individuals in the population had been violated. They were 30% over that level.
That was a typo. Turns out that they thought it was one screen per 10 people.
So there were other examples. Not the dot-coms. My point is really the dot-coms were not alone. In this cycle, the securities prices themselves have been bid up. I have a harder time seeing, and I'd be interested in your thoughts on that, of where other than in the bonds themselves and equity valuations, if the money is being really invested in projects that are that ill-conceived, as we saw in the 2000 period. I think you can point to some spots of trouble, but overall, I guess I just have a hard time seeing something comparable.
How about 16.8 trillion of negative yielding securities?
Yeah, well, I think the securities themselves, the corporations, if anything, particularly recently, have been certainly disappointed the hopes of the tax cutters. All that money was supposed to flow into capital spending. A large portion of it, which I think was very predictable, went into stock buybacks, because that's what happened the last time they did, when they had a tax amnesty that resulted in repatriation. That's what happened then. There was no reason in my mind to expect it to be any different this time. But given that, I guess at least you can say, well, there's rampant speculation, maybe irresponsible speculation in the securities, but the corporations at least are not being diluted into.
Maybe it'll be a sovereign debt problem that's with the corporate. Anyway, Martin is, among other things, and by the way, this reminds me a little bit, and Eric, I know that you think along these same lines, that when you think about negative yielding debt, somehow you think about how to get your stuff through the mail with a minimum of effort and the maximum of efficiency. And this leads me to SendPro Online from Pitt and Post. With SendPro Online, it's just a click, send, and save for as low as $4.99. That's $4.99, ladies and gentlemen, a month. Send envelopes, flats, packages. I guess you could send bonds too, right, Marty? Do they have bonds anymore you could send?
They're pretty well gone at this point.
I guess you could mail the little X's and O's, the ones and zeros, probably.
Yeah.
Right from your desk, and you are back in business in no time. So apart from being a current Yield listener, you'll receive a free 30-day trial to get started and a free 10-pound scale to ensure that you never overpay. Save time and money on mailing and shipping with SendPro Online, starting at $4.99 a month, not $4.99. You can also qualify for special USPS rates for letters and priority mail shipping, calculate exact postage online, print from your PC. So go to pb.com/grantspod to access the special offer. Now it's a free 30-day trial plus a free 10-pound scale to get started. That's pb.com/grantspod. Experience shipping made simple. All right. So Martin Fridson is not only the dean of all high yield, but he's also a very imaginative thinker about finance generally. He's a Harvard man twice. He applied to Indiana University, disappointed, he went to Harvard. And he has been thinking about, in a characteristically imaginative way, about these negative yielding securities, the whole phenomenon. So here, Marty, this is what you have written. How can you default on a negative interest bond? On the face of it, Since you're receiving interest, you can't fail in the obligation. So investors should regard it as a risk-free instrument, regardless of who the issuer is. That's right?
Well, it's attractive as a concept. There is a fallacy in there that issuer may have other debt that is interest-bearing, and if it defaults on that debt, there's likely a cross-default provision which would put your bond into default, even though it's impossible for it to fail on an
Kind of a
interest payment.
dispiriting thing. I thought we were home free with this stuff.
Well, let's take the Alpine nation of Switzerland. I believe that their bonds are negative out to 30 years. Their entire yield curve.
50.
50. It's all negative. So Switzerland can't default.
Well, no, it has outstanding. I think it has outstanding some. But excuse me, I didn't mean to be pedantic, Evan. You go ahead.
Yeah. So for Switzerland, where all their bonds are
Well, there is one other catch, which is there's rollover risk. So if, notwithstanding the fact that you've been collecting interest on it all along, when it comes to maturity, assuming there is a maturity, and in most cases there is, and in some cases they have maturities as far as 100 years out nowadays, but if you cannot roll it over at maturity, then that's a principal default. So there is at least one other way for them. So yeah, definitely don't go out buying these on the assumption that they're AAA credits, regardless who the issuer is.
I don't know. I got an idea. So there was a letter to the editor in the Wall Street Journal this morning. You might have seen it was a proposal that the U.S. government issue consols, the perpetuals, as Britain has done over the course of a quarter century. Not, of course, of a quarter millennium, 250 years or so. But you begin to, and I yield to the gentleman to my right, ladies and gentlemen, the gentleman in our guest, Marty Fridson. How about, Marty, this is going to say, but keep an open mind. Zero coupon, perpetual, price to yield less than nothing. What do you think?
It's a terrific deal. I would, if I were in the Treasury, I would jump on the opportunity if I could get people to
What do you
buy
think?
it.
Yeah, that's public finance, no?
I think we need to nominate him to the Treasury.
Yeah, well, it's a...
One encouraging fact is that the reception to Germany's 30-year negative rate bond was somewhat lukewarm. So while there were some buyers, at least that was some sign that there may be some sanity left in the system.
But wait a second. Now, you, Marty, are not exactly, I think, a by-the-letter advocate of the efficient markets hypothesis, but I have crossed swords with you, or at least I have observed a sword itching to be crossed from your direction about comments casting aspersions on the efficiency of the market. Are you saying that the bond market is not efficient?
Well, I tell you, when you get to negative rates, I think that it may be hard to determine. And, there are, I think that just on a serious note, the efficient market hypothesis, I think, is a great null hypothesis. I think it was a real contribution. And to say, all right, that's the starting point. Now let's test against that. And there have been many, many studies, and there have been some, I think, very credible exceptions that have been found. But I think that's the test that you have to put any investment strategy up against.
Paul Isaac, the man of so many original ideas himself, suggests that the whole bond market is suffering from Stockholm syndrome. It is now the willing facilitator of its captors, the central banks. I mean, it is drive into guaranteed nominal losses. Anyway, I hear someone preaching, which I think evidence almost the symbol, the bell for a closing.
Well, one last question for Marty, though. So, Marty, when you talk about what is the fair price for a bond, you talk about what is the spread and what is that spread relative to history and also relative to your model, which takes in economic and financial market inputs. But the problem is there have to be certain absolute levels of yield that don't make sense. High yield bonds default. These are risky credits, and at a certain point, if the yield falls below the long-term default rate, you might say that you're not being compensated for the risk. In Europe today, corporate bonds yield 25 basis points. That's 1/4%. And high yield bonds there yield 2.77%. What's kind of the long-term default rate for high yield bonds? At what point do you say that regardless of the spread, regardless of where that safe asset that has been manipulated by the governments, this just does not make sense anymore?
Yeah, I have addressed that at a couple of points. The high yield spread got to a level where you could say you couldn't really justify it on any kind of a long-term basis. The default rate historically runs about 4.5%. That's the probability of default. The loss given default, because you generally recover some portion of your initial investment, runs more in the between 2.5%, 3% kind of a range. And there have been a couple of occasions when the spread actually fell below that level. So you were not getting paid any premium over treasuries, which you would certainly buy in preference to high yield bonds if you weren't getting sufficient premium. So we're still a good distance from that, but last I checked, the spread on the ICE B of A Merrill Lynch U.S. high yield index was, still a little over 400. Based on that, we have a ways to go before we get to an absolute level where you say it just does not make sense at all. Notwithstanding the fact that they're very expensive, and that could mean you have a very big loss if the market adjusts to the proper level.
One thing that strikes me about our discussion, more than that, about many or most discussions about bonds and about this extraordinary rally and about these extraordinary levels, is that inflation almost never seems to figure into the list of worries or analysis. People are, I think, spooked about a potential deflation, which is defined very liberally by the central bankers as anything below two-ish.
Well, they're really talking about disinflation rather than deflation. And that's gotten...
But, is it, I know that, Marty, you are not an economist to your great credit, but rather someone who deals with tickers and CUSIPs and investments. But you are also a thinker. Inflation is what they say they are seeking. And it is, of course, the mortal enemy of fixed income securities. A bond is nothing but the promise to pay money, and they mean to depreciate that money. They being the central bankers. So is it possible the entire asset class is going to be scorched simply because, someone miscalculates and trade war turns into something serious rather than something rhetorical? And I guess it's already serious enough, but it wouldn't take much, I suppose, to rejigger production supply lines and to botch things up such that the CPI is running at 4 rather than 2 or 1 point something or other. What happens to all these bonds, trillions and trillions of them yielding nothing less, only a little bit more?
Yeah, I think that's a genuine risk. I mean, I think the hyperinflation risk is a different story because
I'm talking about 4.
But talking about 4, no, because we have people asking about both, and saying, well, is it going to 18?
Let's go to 4 first.
But as far as going to 4, my recollection, and I was around at the time, was that the idea of fine-tuning of the economy was abandoned sometime in the 1970s. And people seem to have forgotten that.
Much.
I mean,
we don't just fine-tune the economy. We also fine-tune elections now through monetary policy.
I mean, but, the idea that, you can keep it under that tight of control. You're saying our target is 2%. We're going to make sure it doesn't go to 2.25%. And for that matter, to 4.
What's the margin for error in the sampling technique for CPI? Would it be 1 basis point? or perhaps more?
Because the whole point is that once inflationary psychology comes in, that's much more difficult to control. So I think you have to be skeptical of the idea that the Fed can do it. And by the way, the economists who were disparaging a moment ago, wouldn't condemn them as a group or anything like that, but I think they do have a tendency to have excessive confidence in the ability of government using taxes and instruments.
Unfairly. Well, Marty Fridson, we thank you. It's been terrific, and thank you for all your good work. Evan, good to see you. I suppose I'll see you around the campus. Eric, thanks for doing such a good job with those controls. Eric went on vacation, as is his wont. He went to an interesting place. I forgot now. It was Yemen, I think. Was it not? Well,
tourist sites aren't very crowded.
Ladies and gentlemen, we are back from vacation, and I don't know, the first day of school, it doesn't always feel funny. You get your protractor and compass and your pencil box and your knapsack, which has none of the usual stuff in the bottom of it because it's new. Everything smells different. But I suppose we'll talk again before June, right before school's out. Great.
Terrific.
Thank you. Ladies and gentlemen, until next time, this is Current Yield. I'm Jim Grant.